In 1972, Buffett and Charlie Munger bought a company called See's Candy. And it's a small California company. They paid 3 times book value. They were choking at the price. Warren at that time was a deep value guy, always wanted to buy things at a discount. Here he was buying a business where 2/3 of the money evaporated, basically, it was intangibles. And they paid about, I think, 13, 14 times trailing earnings for that business. And they were really choking on the price, where they finally said that if the family wanted even $10,000 more, they would have walked. And they paid about $25 million for that business. And he always left his managers alone to run the business. But he told his manager, Chuck Huggins, that on December 26th every year, I will set the prices for the following year. So he used to go to the See's Candy price list, and he raised the prices every year by 10%. And what blew him away was that they raised prices by 10% and sales went up. And then the next year they raised it another 10%. And this is, in a country with an inflation rate of 2, 3, 4%. And for 50 years, they've been raising the prices 10%. A few years back, north of $3 billion in dividends to Berkshire. And Warren and Charlie said that they could have paid $100 million, even $150 million for the business, 6 times, 5 times what they paid, and it would have been a bargain. But at that time, when they bought the business, they didn't know that or understand that. But it took them about 5 or 10 years, probably more, maybe like 15 years, to truly understand the power of See's and the power of brands. And in 1988, they made an investment in Coca-Cola. And at that time, he put 1/4 of the total book value of Berkshire Hathaway into a single stock, Coke. Huge bet. Some insurance company buying a, company they don't control. And Coke was a huge home run. And Warren said that if they had not made the See's investment, they would not be able to make the Coke investment, because they would never understand Coke. And the Apple investment, which was more recent, would not have happened without See's or Coke. So it was not actually a tech investment, it was an investment in a brand and consumer behavior. He understood consumer behavior. So when we look at investing, it has to be a complete no-brainer at the time you're making the investment. So whatever opportunity is in front of you, if you need a spreadsheet, it's a pass. If you need Excel, it's a pass. If you cannot do the math in your head that I'll put this money out today and in 3 years I'll get it all back, or in 4 years I'll get it all back, it's a pass. And there will be investments that will show up at unpredictable times, and at times sometimes when you don't expect. Our job as an investor is to be like a salmon fisherman standing by a stream with a spear. Doesn't know when a juicy salmon would go by, but he has to be very patient, waiting for a long time.